Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. And the Talking Point today are the views of Siddhartha Bhaiya of Aequitas Investment Consultancy. I was looking at the track record. This is the first time that we're speaking to Siddhartha on BloombergQuint, by the way. And Siddhartha, welcome to the show. Thank you for joining me.
Thanks a lot, Neeraj. It's a pleasure to be here.
Thank you. So I was looking at the track record of Aequitas PMS. I'm using one of the products that they have. And when I looked at the time frames consistently, though you don't look at 1 month, 3 month, and 6 month performances typically in a PMS, but when I look across time frames, they have beaten the Nifty 50 and beaten presumably the benchmark, which is the BSE small cap, by a hefty margin since inception and since various time frames. So clearly they are doing something right, which is leading them to do this. So that's the focus of the next 20 minutes of the show, to try and figure out how does Siddhartha think about the current investment landscape and the opportunities thereof. Siddhartha, at the outset, are you a bit more worried about the investing landscape as it is currently because of the headwinds that are visible, or are you sensing opportunities within those headwinds?
So to be honest with you, Neeraj, I'm fairly worried about the markets, but I'm fairly bullish about my portfolio, and I guess every fund manager thinks on those lines, right? But I think we identified commodities a couple of years back, right? We have a lot of exposure to commodities, global commodities, whether it is hard commodities or soft commodities. And in fact, in the last 3 to 4 months, in the last 3 to 4 months, we've had a good run post the Russian invasion into Ukraine. I think this is a rally which is going to continue for the next 3 to 4 years.
Okay.
Right. Last 10 years, we've not seen any. Last decade, we have not seen any investments as far as commodities is concerned. So I think, and with the global money printing that has happened.
Okay, let's take a moment. We'll give Siddhartha just a moment to maybe.
I think I'm getting some sunlight on me. So, do you want to re-record this?
No, we are live, Siddhartha. But if you want to just try and change the frame a bit, let's take a minute and do that, Siddhartha. No worries at all. No, you don't have to be sorry. It's completely.
No, so I think the next 10 years we're going to see, next 4 to 5 years we're going to see significant investments as far as commodities is concerned. The commodity sector we feel is going to do it really well. There are severe commodity shortages globally, and with the money printing that has happened, I think the sector is going to do really well.
Okay. Let me try and viewers give you a preamble, Siddhartha. You can just make yourself comfortable if you need to. We have another 15 minutes of this conversation, so might have.
No issues. I just had a little sunlight coming on me. That's it. Nothing else.
Can happen. Completely fine. I think everybody understands that these days. And thanks. You are in a hotel room, as I can see. So just good to have you. Okay. Siddhartha, when I read your note, it interestingly said that you, and correct me if I'm wrong, but you try to position yourselves slightly ahead of time into pockets which are unloved and maybe undiscovered by the market. Now, is that my correct assessment when I read your note?
Yes.
And therefore, are you kind of weaning out of the positions that you built, for example, in commodities or some other pockets, simply because now everybody seems to be riding that wave already? And are you kind of moving into newer avenues which people might not have discovered or might not be overweight on thus far?
So Neeraj, I think first, cycles last longer than most people's memories do, right? The first question I ask everyone is, do you know who the richest person in 2006-07 was? And nobody seems to remember. It was Ellen Mitchell, right? So we're just into the second year as far as the commodity cycle is concerned, right? And most of the funds today are extremely underweight commodities, right? So I see no reason why, this commodity cycle is getting over anytime soon. I see a lot of skeptics right now, right? Yeah. 2 years back, I got heavily trolled for recommending oil and metal stocks. At least I don't get trolled anymore, right? And till the time people say, oh, wow, this is it, the commodities are going to be here forever. Right? Even in 2007, even Buffett came and said that, look, we are going to run out of oil. Those were his words. And 2020, everyone was saying that the world doesn't need oil anymore. And according to me, I still think oil is bigger than the internet. That's a very, and this is a statement I made nearly 18 months back. Okay. So oil is still, we cannot survive without oil. You cannot have a Tesla without oil, because Tesla needs, aluminum, and aluminum needs calcined petroleum coke. You cannot manufacture steel without graphite electrodes, right? We all said plastic is a dying industry, and look at what has happened after COVID. We are all drinking water out of bottled waters. Everywhere you go, it's bottled waters, right? Ethanol, right? The ethanol story. Ethanol works. If oil prices go up, it makes sense to move to ethanol. But what it does is it reduces acreage for other crops. So that is where you're going to see a massive food inflation. Right? Polyester, cotton is a substitute. So when oil does well, there are a whole host of industries which do well along with oil. The percentage of population that gets benefited when oil does well is phenomenal. So I think this is really going to take some while before. I want to see everyone talking commodities before the commodity will run this.
Okay. Actually, that's an interesting point you raised, Siddhartha, and not many people dig deep, second layer, third layer, second order, third order thinking. Can you talk a bit about that, if you don't mind? I mean, when everybody's focused on the oil rally and what could happen thereof, you are here telling us about how some of the second order, third order derivative plays, sectors, industries, populace which depends on them, could actually do really well. Can you talk a bit about this?
So I think, Neeraj, you have to look at it again. As I said, 2005-6, you had. I'll just take you through cycles. 2005-6, you had something like GlaxoSmithKline Consumer and Britannia available at 10 times earnings, trailing earnings, with nearly 40-50% of net cash and market cap. And at that point in time, nobody wanted to buy those stocks. People were busy buying some of the other popular names like Jaiprakash and Punj Lloyd and IBRCL.
True.
2020, Bector Foods comes, and I don't know how many times the IPO got subscribed. And that's how cycles play out. At the bottom, people don't want to buy an Hindalco or a JSW Steel. Second rung, they would want to come and buy, some of the more popular, the second rung names, the more stable companies. Eventually, they will buy the Gallant Ispats and, I don't know which ones of the name. And finally, when you will have the IPOs coming in frenzy, probably that's when the cycle will peak out. You look at it, right? Tech boom, right? The internet stocks or, the new age plays, they all peaked out when their IPOs came. Right. So it's going to be a while before this rally, kind of fizzles out. Okay. You have to look at cycles. Cycles can last longer than most people's memories.
Yeah, you just mentioned that too. Yeah. So let me try and probe that a bit, if you don't mind, and then we'll move on to some other pockets too. Yeah. So let's take that example of oil upstream. And all through the last 12 months, Siddharth, there was a bit of disbelief in whether or not this can happen. Even if it were to happen, even if crude oil prices were to go up, there was a bit of a disbelief about whether the upstream companies will be able to capture them in their earnings. And when there's an evidence that they are able to capture that because the APM gas price and oil prices are higher, there is a disbelief about whether they can actually produce in the right proportion or the right way because their facilities are old, etc., etc., etc. There's still a bit of a disbelief about whether oil upstream can really do what the crude price is kind of reflecting. What are your thoughts here?
See, honestly, I don't look at ONGC. I don't look at Coal India. They are very, very valuable companies, right? But the government is not going to allow them to make money. I'll be very honest with you. I have gone on record and said Coal India can be our own Saudi Aramco. But it keeps on selling at prices which are at a steep discount to current market price. Same with ONGC. I really don't care whether APM gas is at $2 or $4 or $6. Till the time it is not, there are several other, oil-related plays in India.
Okay.
I'm not talking about the larger companies, somewhere down below, right? It could be the pipe companies. It could be companies related to the CNG sector. There are so many other. They could be drilling companies. See, most of these companies people don't remember. They were very popular back then in 2004 to 2007. And probably those stocks have corrected 90-95% over the last 12, 13 years. It's fallen off the radar.
Yeah, sure.
So, as I said, yes, ONGC, and till the time prices are regulated, they're not free market. They're never going to make money. Even Coal India, look at it, the kind of reserves that Coal India has. It's an energy play. See, Neeraj, at the end of the day, we have an energy crisis right now. Okay. And you look at it, for more than 11, 12 years, we have not invested in energy, whether it is oil, whether it is coal, thanks to the ESG brigade. And you now today have a serious crisis, right? Germany is facing a crisis. Not many people realize that when Fukushima happened in Japan, Germany actually shut down all its nuclear reactors. And today, it's a consequence of those decisions. These are second order thoughts, that what a policy decision taken in 2014 is coming to haunt Germany today. I have friends in Germany who are saying, look, we turn off the heating in the day, we switch off our fans. It's that bad. A loaf of bread which was 2.5 euros is today 10 euros. So we're used to conserving energy. You know, we are used to our moms telling fan band karo.
Yes,
Right?
yes.
And this is something which is happening in Germany. So yeah, interesting times.
There is. So, okay. So I get your point. Okay. So commodities is one place, second order, third order derivatives. How are you looking at the inflationary aspect? There is a thought that sticky inflation, and we will be in the sticky inflation as countries and companies move away from China and look at other supply chains. But that sticky inflation could be beneficial for certain companies and countries, including India. That is one school of thought. Do you subscribe to that? And
Yes.
if so, how do you can you tell us a bit about it?
There are certain pockets of the markets which are going to benefit from the sticky inflation. My bigger worry is not inflation. Inflation is here, right? We've had more than 2-3 months now of oil prices at $100 plus, and the current retail prices of petrol and diesel don't reflect that. Right? So I'm not here to take a call on whether this is going to remain. I look at it on a day-to-day basis.
Sure.
Right? And you look at it, most of the central bankers, the people who are supposed to decide our future have gone wrong. And that's where I feel, it's a terrible thing, because those are the 6-12 people sitting in the Fed who decide the future of our kids. And they can go, if they go wrong, we are in for a mess. So inflation is here. I'm going to monitor it on a weekly basis, on a monthly basis. I'm not going to take a call as to whether commodities are going to go down or not. That's what majority of the people try and second guess it. The fact of the matter is, a lot of weightage has to be given to the current situation, and a much smaller weightage has to be given as to what you think. Right? So there are certain sectors which are going to do well. Again, Neeraj has said B2B manufacturing is a sector which we are very, very bullish on. And if you look at it, B2B manufacturing is a segment which hasn't done well for more than a decade. You look at 2007 to 2020, 2010 to 2020 was a decade of very low inflation globally. Okay, and even lower interest rates. What happened is China became the manufacturer to the world. And most of the governments were very happy looking the other way and saying, let's import from China. The consumer was happy because he was getting, and most of the goods were getting, import. When they were getting imported, they were under invoiced. So the consumer was happy, the government was happy. Who cares about the industrialists, because they don't vote? And that was true globally, whether it is US, whether it is Europe, whether it is India. 3 things have happened since then. Okay, China attacked India, so nationalism went through the roof, right? Everybody said, at least for the 15 days, they said, we'll boycott Chinese goods, and then they went and bought their OnePlus phones on the side. But besides that, so there is an impetus from India, from all countries, particularly India, to manufacture locally. I think that's a very, very good thing, because in the long run, it creates a lot of jobs, right? Second is China itself has kind of become a developed country. Right, they focused on environment themselves, so they don't want to anymore export low value added products. Rather, they would, chemicals is a classic example, right? And third is so one, imports from China are down. Second, domestic demand is strong because of the global money printing. And third, there are a lot of export opportunities to US and Europe. And B2B is a sector which hasn't seen any investment in the last decade, whether it is tires, whether it is steel, whether it is, so many other segments. There was no, because if washing machines were getting imported from China and Thailand, where was the need to set up steel plants in the country? Right? Tires, Maruti and Bajaj were busy importing from China. So there was not much of, there's so many industries like that. There are so many industries. So I think these are the industries which are going to do really well. Right? At some point in time, maybe pharma, media, right, could do well in the future. Everybody, when Netflix came, when people say this is the end of a particular sector, that's probably the time to look at that sector. And when people say this is a secular sector, that is the time to, go and sell that sector.
Have you sold out of IT then?
So we've not had any exposure to IT, honestly, right? We've not had any exposure to banking, and we've not had any exposure to consumers.
Wow.
And that's the secret sauce for our last 2 years, or rather, even for the last 9 years, we've not bought the popular sectors. The key to making money is buying the non-popular ones. And I can tell you, 2016, nobody was buying IT. When Infosys was available sub 10 P multiples, when the likes of Coforge and Persistent were available sub 10 P multiples.
True.
Right. So every sector, once a decade, offers an opportunity. Can you lap onto it at that point in time? You have so many media companies quoting at such attractive valuations right now. A lot of them have net cash on the balance sheet. A lot of them are, single-digit P multiples.
Okay, great. Siddhartha, before we wrap up, we started off this interaction. You said that specific pockets might do well, but you are worried about the markets. What is the principal cause for worry?
I think runaway inflation, a very high fiscal deficit. Right, we're talking about 6.5% fiscal deficit. That's a very, very, very large number, right? I think red hot inflation. That's my bigger concern. You're going to see the wage inflation part has not been even felt in the economy till now. The second aspect that's going to come is wage inflation. We're only seeing as far as one factor of production, which is materials, is concerned. So I think that's interest rates have to rise. Interest rates have to rise, and my bigger worry is if inflation, you're not able to control inflation. This could be a 70s kind of a scenario where everything collapses, right? So it's a very, very. I think all central bankers are terribly behind the curve. You look at the INR, right? We're at 77. We're in a very precarious position, and when things go bad, they go really bad very quickly. You saw that happening with Sri Lanka. You're seeing that happen with Nepal and Pakistan. So yeah, I don't want to be very, very this, but I'll be a little worried. Yes.
Got it. So the last question before we wrap up, you mentioned 70s, right? US 70s or India 2008 to 13. We saw very swift contraction of multiples accompanied with whatever happened to earnings. Do you reckon higher interest rates could also cause that, Siddhartha? Because currently everybody says 20 times we are okay, maybe. Could that be a worry too?
It's crazy, right? When people say I have to buy stocks at 30 P multiples, it's crazy. You have to understand 30 P were exit P multiples. See, in the 80s and 90s, when interest rates were at 17 and 18%, you bought stocks at 10% dividend yield. In the 90s and 2000, you bought stocks at 10 times P multiple. And when interest rates became 0%, practically your cost of capital was zero. See, these are things which play out in a very subtle manner over a much larger period of time. You have to just go and look at the 30-year US 10-year chart, GSEC chart, right? From 17, 18%, it went all the way down to 0%. So I think definitely your cost of capital is going to increase. Money will move out from the stock markets into fixed deposits, into gold, into real estate over a period of time. And I think yes, multiples will contract. Goes without saying.
So that unfortunately we have to wrap up because of paucity of time. But it was lovely talking to you today.
Thank you.
We look forward to having you more often on our forum.
Thank you. Thanks a lot, Neeraj.
The pleasure was ours. Viewers, I hope you enjoyed this as much as I did. Thanks for tuning in.